Today, batten down the hatches with Tony Locantro. Hello again, it's Martin North from Digital Finance Analytics, one that is Post, covering finance and problem news with a distinctively Australian flavour. Today I'm joined again by Tony Locantro from Alto Capital. Hello, Tony.
Evening, Martin. Hope all is going well with you.
Yeah, hanging in there by my fingernails. It's so busy at the moment. I've got thousands and thousands of requests from people to tell them about how mortgage stress is looking in their particular postcode. I did a live stream the other day and I showed people my mortgage stress tool, which gives you information down the postcode level. And I've had a surge of people wanting information. There's a lot of people who are pretty nervous at the moment.
Yes, certainly in Perth. Tomorrow at about 1 p.m, we're going to get hit with a once in 26-year storm, they call it. So the mother of all storms. And I think it's probably a good chance for anyone to put their Porsche Cayenne under a tree. So I know I've spoken about insurance fraud coming. Unfortunately, it's all going to come true. And I think that's the way it is. You know, we all end up with these flash cars and flash lifestyles, and we realise, does it really matter? And my best friend, she comes from a communist country. She was there till about the age of 17. And just the difference of her associating with me, I'm in finance and she comes from communism, and basic things. And she just can't believe the rampant consumerism in Australia, which is sadly coming to an end. And today I was giving a lot of thought as to all these knock-on effects. And I actually got a letter in the mail, which was my first child support payment from my ex-wife for $18.31. And I'm thinking, wow, I mean, I was paying $4,000 a month after-tax child support. I'm thinking, what about all those poor parents, mainly fathers, who are now going to have child support debts build up as well on their mortgage debt holidays, and then they've got the prospect of no job, JobKeeper, or little job security. And I liken the storm coming to Perth tomorrow as it's the perfect economic shitstorm, for better words, Martin. And I just don't think anyone's prepared for it or has actually sat down and gone through all the knock-on effects. Like, all the kids are going to get yanked from private schools, public schools will become overwhelmed, we've got all these debts. I see Westpac have offered customers a year's grace from going back to P&I loans as well. And people on P&I loans can switch to interest only. I just think it's just pushing back against the cliff.
Well, of course, it's in the interest of Westpac to do that, right? Because the last thing they want is a mortgage default, particularly Westpac with their very large exposure to interest-only loans and to investment loans. So it is a bit self-interested as well as perhaps individuals. And I just wonder how much of this pushing the the cliff away a little bit and saying, well, you've got a few months of leeway here is really helping people, because the risk that I see is that you basically just accumulate more debt and you push it out a bit further, and then it still gets worse and worse and worse. Maybe there will be a bounce back for some parts of the economy and for some people, but my surveys are showing that there is a definite degrading in terms of employment and also hours worked as well. So people are not working the amount they were. And a lot of businesses have gone, so they're not going to come back. And we of course now know that rather than it being 6.5 million people who are getting support from the JobKeeper, we know it's only 3 million or 3.5 million. And that means that there's an additional chunk of people who the government thought were getting support, but they're not getting support. And I'm seeing that in my survey. I couldn't understand why my surveys were showing a much more serious problem than what the government was saying. Now I know why, because they got the numbers wrong. So we've got this big crunch happening. And as you say, it's so multifaceted. It's like a sort of a pack of dynamos. You knock the first one over and then the next one goes, the next one goes, the next one goes. And one of the little indicators I'm looking at now is the rise in payday lending. and the rise in afterpay, because those are forms of credit which are easily accessible, although they're pretty risky if you're not careful how you use them. And I'm seeing significant rise there. I'm writing a report for another client at the moment on that particular point. So almost wherever you look, the tentacles are getting more and more extended, and it's just going to look, I think, more and more uncomfortable ahead.
Yeah, speaking of Afterpay, there was a story last night on Channel 7 News here about new investors flooding into the stock market. And the lady interviewed said, well, she's just made 100% on Afterpay. Now, that stock's now back over $44. It went sub 10. So it doesn't show you the power of fundamentals. It shows you the power of fund money. And figures in the States show that a lot of people that previously were sports bettors are now switching to the stock market. New brokerage accounts, platforms in Australia are up 356%. Now, I'm thinking that people that come into the stock market, inexperienced, they'll go to a barbecue. Eventually, we can have people at barbecue, and they'll start to get tips, and they'll lose money hand over fist for 4 to 5 years, like most new investors do. So now we've got payday lending problems because the interest rates are astronomical, gets you into bad habits, gambling on the stock market, more bad habits. So I think you're probably best to try and stay as mentally healthy as possible. And that's what I'm trying to teach my clients. Stay mentally healthy. Don't take these loans. But it's some unbelievable situation, and it's only going to get worse, and all these debts building up. And I just feel for the poor people out there that, calls to Lifeline up 51%, and suicides are rising. I think the only country they're falling is Japan. So they have their own idiosyncrasies. But this is scary stuff, and you're right about the dominoes because it affects every aspect. If a father can't support children, then that affects their lives, and so on and so on. So, no, this is amazing times. It's probably the word of this year will be unprecedented.
Yeah, I think that's right, and it is unprecedented. Another example, of course, is retail. So the proportion of transactions online is now up to 10%, right, according to the ABS statistics. And again, a lot of my surveys are showing me that people in the retail sector are now actually seriously questioning whether they will go back to physical retailing or whether they will maintain just an online presence. And that could fundamentally transform the high street. It also, of course, puts downward pressure on demand for rental space for retail. There's a lot of that being built, a lot of it around the place, and that's going to have a knock-on effect in terms of property trusts and how they're going to perform. What people are going to pay for renting retail accommodation later. I mean, wherever you look, you can see another thing going ting, ting, ting. It's just remarkable. I don't think there's a corner of the economy that is not being fundamentally crunched in one way or another at the moment. And even, if you look at, the Coles and Woolies, they had this big spike in the early part, but in fact now they're deeply discounting a lot of meat, for example, because suddenly the demand's gone off because people can't go on buying at the same rate that they did a couple of months ago.
Yeah, I got a dose of retail therapy last weekend, so I went to Myer. And the problem with this working from home is the access to the fridge and grated cheese. So, I'm trying to cut down my expenditure, but all I did was buy one extra large polo shirt. Because I got down to large, I'm proud to get to... And that's it. I work hard, so I do okay, but I don't want to go out and spend lots of money. And I think all this consumerism crap and the endless supply of Louis Vuitton bags and the soccer mums in their Porsche Cayennes, I think people are going to look at that and think, wow, the real wank factor is going to be removed from society. I was part of it. I was part of it as well because we're all consumeristic junkies, and to meet someone that comes from a communist background, you think, does all this shit really matter? And to be honest, it doesn't. And you've got to work at what makes you happy. And I think sadly at the moment, people that can survive are going to be the happiest. But then, geez, we've got the property cliff coming then as well. So,
yeah. Well, it's very interesting. If you look at the GDP numbers, right, half of the GDP in Australia was household consumption. In other words, you and I and everybody else spending and buying stuff, right? Now, the latest statistics in terms of confidence and expectation to spend has gone through the floor. I'm not sure that's coming back. So I think you're absolutely right. There is a fundamental reassessment going on in people's minds about what's really important. And, and frankly, just buying more stuff for the sake of buying more stuff. Now, we've been fed that for a generation or two as effectively one of the strongest growth levers in terms of driving the economy forward, right? And actually, it's been at the expense of real investment in real things that will actually support the economy long term. So this sort of frothy consumerist society that we've been part of is really, I think, coming apart at the seams. And then, as you say, you've got the property wave coming over the top. And I'm seeing, everywhere I look in my surveys, I think last time we spoke, there were about 8% of property investors signaling their intent to try and sell their properties. Well, that's gone up to 12% now. So we've almost seen a significant rise in the last month or so. And the first wave was the Airbnb guys who suddenly couldn't make it work. But now we're seeing a broader swathe of property investors with the rentals dropping through the floor. And while some can get interest-only loans, many can't. And the economics aren't working. So they're trying to get out before the values drop further. And it's very interesting, like you've noticed, Tony, how all of the real estate institutes and all the property guys are saying, no, it's all right, everything's fine. Property prices aren't sliding at all. But of course, the CoreLogic index disappeared this week.
Yeah, I saw Edwin's funeral to that. It's like, well, let's just get rid of the All Ords when it falls below a certain level. But, as I've said in many talks before, what textbook economists don't understand is the basic mechanics of a speculative bubble. And that's all it is. And when a bubble bursts, 40 to 50% downside of the quality, so that stock's included, and the rubbish loses 70 to 80% in value. That's the norm. People think, well, how can that happen to property? Well, guess what? It can. And, when you've got CBA saying down 32%, you've got HSBC came out with their negative forecast, and Chris Joy's gone total contrarian now, so he's saying 20 to 30% upside. I mean, think about it. These are people's lives, and I think fair value now, honestly, we're looking at 4 to 5 times income is where houses should be. I don't think it'll get there, but even at 6, they've got to halve. But I'm just trying to keep it simple for viewers, because the Japanese stock market had a bubble in 1989, and that's the similar ridiculous valuations applied to Sydney and Melbourne real estate. That is unsustainable, and you look at where Japan has been the last 30 years.
Yeah, well, Japan has been in a crunch down for a long time. The central bank's been buying up most of Japan through their quantitative easing programs, from junk bonds through to the stock market. We're going to see, I think, similar attempts to try and support the economy here. But I think the attempt to try and support the property sector is not going to be successful, because, as you say, once you understand how the bubble works, there is a point at which the deflationary effect of the bubble is just unstoppable. And I think we're probably now in the early stages of that. And, I've said for some time that in absolute terms, we're at least 40% over where we should be. That will come back. It will vary. There's probably some properties that will do better than others. But there's a lot of dogs of properties that people have. And I was talking to a real estate agent the other day for a separate show. And she said to me, people don't realize that a dog of a property is always a dog of a property, right? So it doesn't suddenly turn into a wonderful investment later. If it's a bad investment on day one, it's going to always be a bad investment. And a lot of people in property have no understanding of that fact, that, if you buy the wrong property, if you buy a lot of high-rise stuff, if it's poorly constructed, it's lots and lots all the same, those are not good investments.
No, definitely not. And I used the terrible analogy in one of our interviews where I think the Sydney-Melbourne property market is as fragile. It's like a new couple. They're out dating and they're always trying to hold in their bodily functions. They're not trying to after dinner, and then suddenly they go out for a pork roll in Melbourne and they get a bad case of gastro. All bets are off. And that's how fragile it is. People don't realise how fragile it truly is. And I looked at some suburbs in Perth today, some of the lower median suburbs, and you can pick up a house 30 kilometres from the city on 600 square metres for $180,000. Admittedly, you've got drug problems, drug issues, higher crime, but they're family areas, and that's with a 1 in front of it, and that's a house. So I don't know why that should compare 180 as opposed to a dog box in Mount Druitt for $800,000. So everything will even out, but I think what's going to happen is that once price discovery is made in certain suburbs, all bets are off. And I was actually speaking to a real estate agent in Melbourne, and he was saying that some people have been offered, say, $1.6 million on a house where they're just chasing another $20,000, $30,000, $40,000. If anyone's in that situation, for God's sake, take it. Take it. Because if you want, I mean, Australian house prices in real terms did nothing for 60 years. So I think people have got to learn to be able to take the hit now, and because it's not going back to new highs. There's nothing to drive it. And similar valuations on the stock market as well. Everyone looks at the Dow Jones. The Dow Jones is 20,465 points. I believe it's going to create new lows, but it's going to do it slowly. So maybe we stop around 17,000 points, and it did get to 18,200. So that's reality. That's PE ratios are now still around 20 times. Normally they should be 15 to 16. Allowing for this economy, they probably should go to 12 to 13 times, Martin. And that overvaluation is going to be reflected in the Australian property market. But holy hell, it's our most widespread, loved and over-leveraged market. So you can see the disaster coming. And you've seen it for some time.
Yeah, I'm afraid I have. And, you and I both see things somewhat similarly in terms of the psychology and economics of a bubble. But what's fascinating to me is there are still many mainstream people who just don't understand what this is actually doing and what the consequences are, right? So, I've had a few people phone me from political land saying, is it really that serious? Surely we can muddle our way through again like we did a decade ago. And I said, well, do you understand what we did a decade ago? How much help we got from the Fed, for example? 2 of our banks got supported by the Fed. How much injection of support was done from the government here into the banking sector, and how there was a fortunate takeover of one bank by another bank to support the weaker bank. All of those things really people haven't really got their heads around, right? And yet I suspect we're going to see precisely the same dynamics once again. And this time, the drop in unemployment, the drop in employment or the rise in unemployment will be a lot bigger. The underemployment will be dramatic, and the degrading of incomes is going to be, I think, very, very significant. Pull that together. With lack of migration, lack of demand for property. This is, well, did we say unprecedented? I think it probably is.
It is. And a lot of, I've been approached by some viewers as to where they're going to make the money. And pleasing that a lot of your viewers do have a lot of gold and silver, which has done its job beautifully in this crisis. But what will happen is, I've been speaking about Australia detaching itself somewhat from the rest of the world to have our own stock market bubble. And I think that is a huge chance when you've got desperate people and funds. A fund manager they have to pay for their mortgage on their Mossman property, right? So they don't want to be left out. So it's fear of missing out on a bonus. So you could see a massive influx of people trading the stock market, and it'll be mainly companies with no earnings at all. It'll be rubbish. People will be punting rubbish, like the South Korean housewives push Bitcoin. But for the blue chips, I see further downside in the banks. I would be surprised if Westpac hits $10, $11. They're currently around 15. But what I've noticed in this market recovery, the banks are struggling. And at some point, they're going to have to raise more money. And that's discounted rights issues. Berkshire Hathaway will just be rubbing their hands with glee at the moment, because it's going to be a carcass. But that's where we're heading. And so I think the next phase of gambling is not going to be on property and having all these people in the paper owning 16 houses and they're a school teacher. People owning multi-million-dollar share portfolios leveraged to the hilt. And that's where the next bubble is. And don't be surprised, because the long-term effects of COVID-19 aren't known, that we have a 5-year healthcare bubble with a lot of charlatans and sharks along the way. So that's how I see how we're going to make money. Sadly, not from inertia, not from baby boomers doing nothing. You can actually go out and pick stocks now. Major capital cities property markets, 30-40% dead, gone. That's it. There's no buying, let's face it. So I think at some point, Martin, regional areas will be targeted because people can realise, hey, I can work from home. If Atlassian tell all the people they can work from home, Optus, why would you live close to the CBD? Go find a nice regional area with a cafe culture. So things are going to change. Our economy is about to contract. We're going back to the 70s. So unfortunately, there's a lot of pain on the way, and that's what we're seeing now.
And final question, Tony. The small caps and the things like the biotechs and those things, they're still actually worth going after, aren't they?
I have done my last talk. There was a couple of talks I mentioned some stocks, and they've actually done quite well. So what happens when the Dow Jones gets a shellacking, my stocks will halve, and then they'll double and then some. So lately, I don't go 12 rounds with Mike Tyson. My job isn't physical, but it feels as though I'm 12 rounds with a Russian chess master. Because some of my stocks are flying, but they're based on dreams. So I've then got to sell someone out of something and put them into something else. But all this money and people are going to flow into the rubbish stocks because they haven't got the time to research. Facebook trading groups through the roof, Twitter trading groups through the roof. So small caps, unfortunately, a lot of them are going to become massively overvalued. A lot of them are rubbish, but that's in times like this, that's where the money's going to be made. But I tend to stick to the quality small cap stocks, which will come through the ranks. But the ASX is going to get very dangerous.
Well, I appreciate your time once again, Tony. It's always satisfactory talking with you because you see it so clear. And I think that's why the audience love having you on the show and you're sharing your ideas. So thank you for that. We'll talk again soon and batten down for the rather volatile journey ahead, I think, is the message today.
And that the storm coming tomorrow for those in Perth.
Yeah, keep safe and stay out of the wet.
All right. Thanks, Martin.
See ya. Thank you very much, Tony. Take care.